What's up, guys? My name's Curtis, and welcome to 5-Minute Finance, where I take personal finance topics and explain them to you in 5 minutes or less. If you guys have ever done a simple Google search of what the stock market is doing, I'm sure you've come across one, if not all, of the three major indices. The three major stock indices in the United States are the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite Index. Since indices take into account the performance of many different stocks each day, they are a great way to gauge how well the stock market is performing as a whole. However, an index is just that, a measure of the different stock prices that it tracks. So you can't just simply buy, for example, one share of the S&P 500 index for a couple $1,000s. But that's where index funds come into play. These are mutual funds or exchange-traded funds, which are constructed so that their components match that of a specific index. The managers of these funds will buy and sell stocks accordingly so that the portfolio of the index fund matches exactly what the index is basing its price off of. As an example, these two exchange-traded funds, SPY and VOO, both do their best to match exactly what the S&P 500 does. As you can see, both of these funds follow pretty much exactly what the S&P 500 has done. And as you can see, one of the best parts is they're actually cheaper than the price of the index itself. So this just makes it more accessible to investors that maybe don't have as much money to invest. Another great thing about index funds is that there exist index funds for just about every single financial market out there. Whatever you're interested in, whether it's energy, communication, technology, utilities, even video games. A simple Google search will yield many different index fund options in that field that you could put your money into. So instead of buying shares of one single company in a certain industry, you can buy an index fund that's more diverse and will respond based on how that industry performs as a whole. Lastly, when you compare index funds to actively managed funds, they generally have lower expense ratios, which means more money stays in your investment and less money goes to the fund managers. In addition to that, over the course of 10, 20 years or more, an overwhelming majority of actively managed funds do not beat the performance of index funds. It's often said that it's better to be the market as opposed to trying to beat the market. So not only are the fees within index funds generally lower, over the long haul, the returns are actually usually higher, which in my opinion is definitely a win-win situation. So I think index funds are best for investors who simply want their portfolio to reflect what the general market is doing. No better, no worse. They are safe, cheap, and historically over the long haul provide very good average annual returns. If you guys enjoyed this video, please give it a thumbs up. It would greatly help me out, and subscribe if you're not already. Thanks.